basically the type of investments that are available to like institutional investors, retail investors, but it's going to be at a very basic level. It won't be like anything too complicated or sophisticated. Yeah, the presentation will talk about like what to buy, what not to buy, or how much to invest and how much not to invest. It's just basically a fundamental presentation that shows you the value and importance of investing. And just before we dive, and I really like this quote here from Warren Buffett that says, "Risk comes from not knowing what you're doing." And I feel like that's very important. And I hope this presentation kind of help give you guys a better roadmap if you choose to go down the road of investing. So let's dive in. Before we tackle investments, I want to like touch on speculation. So just like how we have an intelligent way to invest, we also have an intelligent way to speculate. And essentially what speculation is basically like, in short, basically gambling. It's basically like, think of it like you go to a casino, you got $1,000, you speculate on those machines, or if someone say, hey, check out this meme coin, Dogecoin or whatever, I think this will go up. Essentially as a speculation because there's no real value or fundamental reason for that to be a great investment. So essentially speculation is gambling. Now, let's talk about like the three unintelligent ways to speculate, just so we can know what not to do if we decide to speculate. Right? Number one is the first unintelligent thing when it comes to speculation is number one, speculating when you think you're investing. So this means you have it confused. You think that you're actually investing, but instead you're speculating. And then number two, you engage in serious speculation without the necessary knowledge or skill. So similar to number one, again, you think that you're really investing, but essentially what you're doing is speculating because you lack the knowledge or skill of what you're actually doing. A lot of people do this without actually knowing, right? So I feel like this presentation can kind of help avoid falling into that trap of speculating when you actually think that you're investing. And then number three, risking more money in speculation than you can afford to lose. Now, those are just the three basic things to avoid when it comes to speculation. Now, if you want to actually try your luck in speculating or gambling, these would be the rules that I think would serve all of us well. So just think of it as principles. It'll always have value no matter how many years from now. But as long as you follow these rules, you speculate, I think it'll serve you well. And I'm not encouraging anyone to speculate, but if you do, these are the rules you should follow. Put aside a portion, the smaller the better, of your capital in a separate fund for that purpose. Number two, never add more money to this account because the market has gone up. In fact, that's the time we should be looking to take funds out of that speculated fund that you have. And number three, never mingle your speculative and investment operations in the same account, nor in any part of your thinking. So essentially, understand the difference between investing and speculation, and it now makes the two of them together. You won't have them completely separate. Thank you. Now, most of the presentation is going to be focused on public company investments, so like stocks. Now, there's many different investments available, but I kind of have this forward focus on public companies. But I will touch on different other investments as well. Now, let's take a look at a case in Apple, right? $1,000 investment in Apple, the iPhone company, in year 2000 would be valued around $600,000 today, right? That is the case that they're going back in the past. Now, none of us knew that Apple would be as large as it is today. So this is obviously in hindsight. We're just looking at past examples. But this still does show you the value of compound returns in good investments over a long period of time. Now, that $1,000 investment, it would now be valued at $600,000, but you would also be receiving a few $1,000s per year in dividends, right? So it's actually worth far more than $600,000 when you put it into perspective because you actually get dividends from it. And to put in comparison, the S&P 500, I don't know if any of you guys know what that is. Yeah, so just to elaborate on that, the S&P 500 is an index that tracks the top 500 largest US companies in America, right? Now, if you had invested $1,000 into that index, 23 years ago, you would have roughly $7,000 today. So you can see that an investment in Apple paid far larger returns than the S&P 500. Both are still good, but they make a huge difference when you find companies that can really grow exponentially over a long period of time and companies that will stay around for the next 20, 30, 40 years. Now, let's just look at some case studies, some examples. Some people like to not look at these things, and some people like to look at it. And I just like to share just as an example of what compound interest is, right? So I have a formula at the top of this page here. It says the formula for wealth is long time periods plus decent returns equal wealth. Now, if you notice in the formula, there's nothing in there about money. The only section that talks about money is the end of the equation, which says wealth, right? Because in reality, to build wealth, you don't need a tremendous amount of money. You just need long periods of time. However, if you have more money, the time frame gets a lot shorter. But the point is, anyone can create wealth, whether you have a little bit of capital or a lot of capital. So in this example here, this is what you would have if you were to invest $500. If you were to start $500 and you were to keep adding to that every month for a total of 30 years, it's a pretty long time, but let's just use this as an example, and you get a return on your investments of 15% compounded every year. Now at the end of 30 years, you'll have roughly around 2.8 million just from a simple $500 investment every single month for 30 years with a rate of return of 15% per year. Now, if you want to know how achievable that is, Warren Buffett, who's the greatest investor of all time, as far as we know, he's been able to compound 20% per year. So this is less than him. And let's just say we can't do 15% because, okay, maybe you think you might need to spend extra time studying, finding good companies, etc. So 15% might be too far. I have another example here, 12%. Now, I believe anywhere from 10 to 15%, perfect. You can create wealth with those rate of returns. Now, this example here is the same example, but with a different rate of return. So $500 invested every month for 30 years at a 12% rate of return. At the end of 30 years, you have about 1.5 million. And at the bottom of these examples, it shows you that at a 15% compounded rate of return, every 5 years, you double your money. So if you have 10,000, 5 years now you have 20,000. The next 5 years you have 40,000. Next 5 years, and it just starts to double. So the real value here is having a decent amount of return in long periods of time, right? And let's say you had a question?
Yeah. So how do you go from the difference of the return rate being 12, 15, or 20?
Well, it really all comes down to the type of investments that you make, right? So if you have an investment that can offer you a 20% return,
Okay, I got it.
Then that's how you gain that 20% return.
Okay.
And there's many different ways you can get that. It isn't just public companies.
Okay.
Let's say, for example, you have a gym and you have franchises, right? And you realize that, okay, if every time I put 100,000 in, I get back a 20% return every year, and I can keep duplicating that. You can create your wealth just from building franchises over a long period of time. So it doesn't necessarily have to be in companies. It can be in your personal company. Well, you just have to determine where the risk is, right? Because, for example, if you invest into a startup, let's say he like your gym idea, he wants to invest in your gym, but essentially you want to been in business for 4 years. He's now taking 4 more risks, which isn't what I'm trying to encourage here. I'm just trying to encourage simple investing where you can easily get 10, 12, 11% return, nothing tremendous, and build wealth. When you invest into a business, a private company, you essentially take more risks. And you could make more, or you have a chance of losing more of your capital. Whereas this route that I'm trying to share, the chance of losing funds is still there, but it's a lot less.
You minimize the risk.
Exactly. You minimize the risk and you just go with decent returns. When you try to go for higher returns, 30, 40, 50%, you take more risk. And then the thing with that is, like, it really destroys the wealth creation process. It destroys the formula because now essentially you're doing long periods of time with high rate of returns. And it destroys the outcome. That makes sense.
You basically overexpose your portfolio by doing it.
Yeah, essentially. Because let's say, for example, right? Let's say you did that for the first 20 years and you took $100,000 to about maybe $900,000 at 20 years, right? Or maybe, let's say $1.5 million, right? But you've been investing into our companies, etc., right? 1 year in particular, out of that 20-year period, the investments drop by 50%. Now you back up from you at 1.5 million, now you're at 750,000, so you're down half.
Yeah.
So to make back the half that you lost, you have to go back through another 5 years, etc. So you gotta make that back first, and you gotta keep going again. So it extends the duration, and it destroys the wealth creation process, if that makes sense. Now, you have two different types of investors. I'll touch on that more in the presentation. But I use an example here of the S&P 500, which is basically, like I explained earlier, index that tracks the top 500 companies in America, the top largest 500 companies in America. Now, since 1993 to 2023, the S&P 500 index gave a return of around 9.9% average per year, right? So that's basically an index or a benchmark that you can say, okay, well, I know that I can possibly get this without taking much tremendous risk. I'll go here because I don't want to worry about studying companies. I don't want to worry about researching and doing all the other stuff, understanding financial statements. I just want to place a bet on America, then America will grow. Because essentially when you invest in the S&P 500, you're essentially saying, I believe that America is going to grow in the future. There was a guy that's talking about America. Okay, you guys are home. So I just going to touch on real quick. So this slide here, this slide here is basically like an example of the type of wealth you can create if you had invested in the S&P 500, right? Now, essentially, investing in the S&P 500 would be saying that you believe that America is going to continue to grow and their economy is going to continue to get larger. So if you believe in America, the S&P 500 is a very simple way to make investments without having to do a lot of active investing or research, etc. Now, at a 10% return over 30 years, investing 500 per month, you see that you get around 1.1 million after 30 years. Now, if we put that in perspective, right, this is just a little bit higher at 12%. You notice you go from 1.1 million to 1.5 million, right? And then here is just a little higher than 12% at 15%. And you notice you go from 1.5 to 2.8 million. So because the interest is being compounded, 1 or 2% extra interest in your return makes a tremendous difference over a long period of time. Right. So I just want to share that. Now, before we get into the real teaching, I just want to give another example. Warren Buffett. I like to study him a lot. And I like to study people that write books on him and the way that he invests. His rules to invest in, number 1 is not to lose money. And number 2, don't forget the first rule, right? Here's a quote by him. Never lose money. Rule number 2, never forget rule number 1. Right? That's what Warren Buffett. Now, a lot of people don't understand what he means by this. I'll explain it. First off, when you invest in, it's impossible not to lose money. You will lose money. So if you're going to invest, just expect to lose money because that's a part of it. But what he truly means is 2 things really. Knowing the type of investments that you're making. If you're making investments and it has the potential of losing or dropping 50% or losing all the money without giving you back your principal, he would avoid those investments because he knows a high degree that he can lose his money. This can still happen with regular companies as well, public companies, but you can gauge the risk a lot better, right? And number 2, he doesn't believe in like purchasing a lot of luxurious items, right? Because he believes that is losing money, right? For example, what he really means is you can purchase a car for $40,000 and you'll have that car, and over time that car will depreciate. You need to buy a new car 10 years later, right? So you can spend more. To him, that is the first rule that he avoids, losing money, because that $40,000 compounded for the next 20, 30 years could be worth over $1 million, right? So he wouldn't invest $40,000 because he know that $40,000 could be 400, 800, or $1 million. Now, to put that in perspective, I have here a $40,000 investment. It's a one-time investment for 20 years at a 12% rate of return. After 20 years, you'd have $385,000. So when investors that actually know how to grow their capital look at purchasing an item like this, they say, okay, well, how much money am I potentially losing? And they look at what they're able to do. Warren Buffett is actually able to do 20% per year So in fact, this would probably be more, maybe $1.5 million from a $40,000 investment. So if you actually know a bit about Warren Buffett, he doesn't own like luxurious cars, big homes,
Simple.
private golf courses. He don't. Yeah, he very simple. Is because he know that each amount of money that he spent has a future value,
Mm.
and if he's wasting money buying stuff to show off or etc. or stuff that just depreciates, it's a waste of money in his time. So he avoids that. He just continuously invests and create wealth. Now, in the same example here, that's 20 years. At 20 years, this $40,000 at 12%, which is an interest rate that the average person can achieve, 12% per year.
Mhm.
It's just 2% above the S&P 500, so it's very attainable. At 20 years, it'll be worth 385,000. At 30 years, another 10 years later, it'll be worth 1.1 million, right? That's just a $40,000 investment. 30 years could be worth over $1 million, right? So that's what these guys think about when they're spending their cash. What is my money worth 10 or 20 or 30 years later? Okay. So I want you guys to think about that too each time you want to spend something, right? That you think you don't really need, right? Not saying you guys shouldn't buy nice stuff, that's your choice, right? But I'm just saying think about the value of what that money could be in the future, right? Now, let's look at the basics now. So we get into the teaching. So when we think about an investment, what do you guys think an investment means? What do you think an investment means? No right or wrong answer.
Yeah, using your money to make it work to get a return out. That's the most basic way, I think.
Yeah, and that's essentially the way it is that you're doing.
Put the money in to get something back.
Yeah.
Exactly. That's exactly the way that you're doing. So I have a definition here by Benjamin Graham, who's the guy that mentored Warren Buffett when he started off. And his definition of what an investment is basically an investment is an operation in which, upon thorough analysis, promises safety of principal. Principal is the initial amount of money that you put in, an adequate return. Notice he doesn't say high returns, adequate return. Operations not meeting these requirements are speculative, and we spoke about speculation in the beginning of the presentation. Now, speculation is basically gambling, right?
Yeah.
So if it doesn't meet this here, if it doesn't promise some sort of safety on the principal that you initially put in, an adequate return, just consider it speculation, right? Now, he also is very heavy on the concept of margin of safety. So he says that all investors face risk no matter how careful you are. Risk is the one thing that you can't eliminate. The approach known as margin of safety is a logical practice to minimize your odds of error. So essentially what he means by margin of safety is if, let's say Tyson wanted to purchase Kendall's gym, and Kendall believes his gym is worth $1 million, right? And Tyson say, okay, well, I think it is worth $1 million too, but if I can get it for maybe 700,000, that provides me a margin of safety, because if then something happened with the economy or if the business loses clients, I still am protected. I have some room for error in case things happen in the business. You're still protected to some extent, and it also means not overpaying for an asset. So if you want to buy a company, and that company is worth $1 million, don't pay 1.1 for it, or 1.2 or 1.5 for it. You don't have no margin of safety. You need to have a room for error.
Yeah.
Because it could be a case where Ken will believe it's worth $1 million, he believes it's worth $1 million, but in fact it isn't. So when you have that margin of safety, you protect yourself from wrong calculations, and also you help boost your returns over time. It helps protect your capital as well, right? Now, future value. So in investments, we always want to be thinking of the future value, right? So the future value of every investment is a function of its present price. The higher the price you pay, the lower your return will be. And the intelligent investor realizes that stocks become more risky, not riskier, when their prices rise. Sorry, I'm saying that again. Stocks become more risky, not less, as their prices rise. And they're less riskier as their prices fall. I hope that makes sense to you guys. So like if the stock market, let's say for example, you guys invest in the stock market, if the market drops by 30 or 40%, it's not more risky. A lot of people feel like, okay, well, the economy is going to crash, let me take on one out. And that's usually what people do. But in fact, that's the time when the economy or the market is actually providing you a margin of safety.
Yeah.
And
Consider it like a discount.
exactly. So you get a discount or something that's worth maybe 20, 30 times more. And many times, like public companies in the stock market as a general, or as a whole, it moves by investors, investor segment, if I'm saying that right. Basically, if a group of investors feel that the economy will go down, the market will move that way. But just because they feel that way doesn't mean that in particular it will happen, you know what I mean?
Yeah.
So like Warren Buffett always say, get greedy when others are fearful, because when others are fearful, the markets tend to drop. That's the time you want to be getting greedy and buy. Essentially what that means, right? So the lower you can get an asset for, is generally the less risk that you take. The higher you pay for that asset, the more risk that you take. For example, let's say you bought $1 million apartment complex and you paid $1 million for it and you sold it for $2 million 5 years later. You made 100% return on your investment. But let's say the same apartment complex, you bought it for $500,000. When you sell it for $2 million, now you make 150%, or actually you make 200% of your money. So you bought it for a lower price and you made a higher return on it. So that's how you want to think about when you're purchasing any sort of investment. What is it worth and what can you get it for? Right? And you want to have some sort of margin of safety. All right. Now we have two types of investors. So each one of us here will fall under one of these type of investors. So either you can be a passive investor or you can be an active investor, right? So essentially, a passive or a defensive investor is one that's basically they're interested in the safety plus freedom from bother. They don't want to be reading reports, reading account statements. They don't want to be looking into the market, know what happened today, what happened with elections. They don't want to do none of that work. They just want that they can make a $40,000 investment or $500 each month and forget about it. And then by the time they're maybe 40, 50, they don't have to work anymore because those investments over the years gave them a future value that they can retire on or so forth. So that's the passive investor. And then you have the active investor, which is what I categorize myself as. The active investor is an investor who has a willingness to devote time and care to the selection of securities or assets that are both sound and more attractive than the average. Now, when we think of the average, just always think of the S&P 500 as the index of the top 500 companies in America. That's the average. So essentially, if you can find which companies out of that index will perform better than the rest of the index, you can get returns above the average, right? So that's where I focus on. Now, we have types of income. Just want to touch on this. This is a little outside of investment, but I just want to touch on this. We have three types of income. We have earned income, portfolio income, and passive income. Now, these are pretty self-explanatory, but I'll still touch on each one of these. So earned income is basically income that you receive from work, wages, tips, commissions, or if you're self-employed or you own business, that's considered earned income. That's the category that your income would fall under. Now, if you have portfolio income, that category would basically be income generated from investments such as stocks, bonds, and real estate. And it can be in the form of capital gains, dividends, or interest. Now, for example, if an investor invested $1,000 in Tesla and the value of that investment of $1,500, that investor would have an unrealized capital gain of $500. Now we have two forms of capital gains. You have unrealized and you have realized. So essentially, unrealized is basically the value of that investment went up, but you haven't sold it yet.
Okay.
So that's unrealized. Or it could have went down in value. Could have went down 50%, for example, but you still haven't sold it. So it's an unrealized gain or unrealized loss. Now, the only way that the capital gain becomes a realized capital gain is if they sell that asset higher than the price that they purchased for it. But you have to physically sell it first to get your funds back. So that's a realized capital gain. You hear that a lot in investments, realized or unrealized. So just wanted to touch on that. Then you have passive income. So passive income is income that you receive without having to actively work for it. So if you did no work and you get income for it, that's considered passive income. Very straightforward. For example, Warren Buffett, he invested 1.8 billion in Coca-Cola years ago. And then today, every single year he receives, well, not every single year, last year in 2022, he received $700 million just in dividends from the company. He had to do no work for that. He just made an investment about 30 years ago. Today he gets $700 million every year from dividends. Some years it fluctuates. Some years maybe 705, 650, it all depends. But that's considered passive because he don't physically have to call the managers, find companies to sell Coca-Cola, and he don't do anything. He just own a part of the business and he gets a part of the profits every year. Now, what do you guys think the requirements of being a successful investor actually is? I know a lot of people think you gotta be really smart, you gotta be a genius, you gotta understand how to read accounting, you gotta understand how to do this and that. I don't know what you guys think of it.
I would probably think it's probably more than like a surround yourself with persons who maybe know are specialists in those kind of areas because you never know everything. But if you do surround yourself with those kind of persons, then that's a plus for you.
Okay. So you feel like you have to have the knowledge as well and the
You
community.
have to have some knowledge, but you're if you're not that kind of investor or the person who's gonna go out and know every little thing, then you need to actually surround yourself and have persons who know.
Yeah. I think that's a smart thing to do, yeah. So I don't know if any of you guys want to give it an answer
I would just say, like, just time,
this time.
yeah. For like pretty much whatever you second and put in on the sheet and take it for. What we're really good about is a good about.
Yeah.
Research and confidence.
Yeah, for sure. Time is like kind of a huge part of the equation. So let's look at an actual example, right? I'll go into the example in a second, but this is what is required to actually be a successful investor. And those questions were good, those answers were good answers also, maybe. So you have to be very patient, time, like you said. You have to be disciplined. Now, discipline is knowing what to do and what not to do. So you have to have rules, right? That's where the discipline comes in. You have to be able to follow those rules. You have to be eager to learn, right? Now, when it says learn, this doesn't mean you have to be like a specialist and understand every single thing, understand how to read the balance sheet, all of that stuff. That's good to learn too, but eager to learn mean that you want to understand what is it you're doing and you have questions and you want to like keep an open mind to learn about certain things. So you always want to be eager to learn, and then you must be able to harness your emotions and think for yourself, right? So if I tell you buy this because I know I'm talking about just buy this, like you don't want to be doing that because that over a long period of time holds you back because you put yourself in a position where you depend on someone else's advice rather than understand what it is that you're doing. I could very well be wrong. More like I'm going to be wrong, right? And you take my advice, both of us go down a drain, right? So this kind of intelligence, which is explained by Benjamin Graham, is a trait more of character than brain. So to be successful in investment, it's more of a thing of behavior and character rather than being like super smart, intelligent, and knowing everything. Right? Now, like, let me just give you a good example. Let's say you work for the company Apple, right? Like you say, you have to be surrounded with the environment. Let's say you work for the company Apple, but you're not a genius. But you know that Apple has a plan in the future to bring computers out, bring phones out, bring a bunch of new technology out that hasn't hit the market yet, and everyone's going to use it. You don't have to be a genius to think that.
Yeah.
You just did your research and you had a story in your head and you said, okay, well, what if Apple could do this? And then you start researching, you start learning, can they actually do it? Keep in mind, you haven't looked at none of their income statements yet, none of that stuff, right? So it's being able to build a story around a company and see if they can achieve it and then learn a bit more about it. That way you can like have an idea what the company will be like in the future. And if they could achieve that in the future, it'll give you an idea what it'll be what it'll be worth in the future. If that makes sense. It's always about building a storyline. You won't have good investments too. So let's touch on rules again, right? So for the basic person, and even for not even the basic, for everyone, these 3 rules here is the rules that I strongly believe create wealth. And I'll share a story about someone who actually built his wealth based on this. So number 1, keep 1 out of every seed that you receive. So essentially, keep 10% out of every dollar you make, right? And number 2, plant the seeds that you keep. So that 10% that you keep, invest it, right? Very basic rules. Every one of us can do this. I don't think if we took 10% of what we make today, it would change our lives. I think we all can do it. If I made $1,000 this week or this month and I put 100 aside, that wouldn't change my life, right? So plant the seeds that you keep. which is the 10%. And number three, let those seeds grow. And like the formula we spoke on earlier, you need long periods of time to let those grow. So if you can be planting a tree, think of it in real life. If you plant a tree, you don't if you plant a mango tree or avocado tree, you don't expect that tree to bear fruit in 3 years. That tree's still growing. So you're waiting on that tree, you're watering that tree, you're learning about that tree, you're seeing what the tree needs, what type of environment it needs to be, etc. That's what you're doing in those first amount of years. Now, 5, 7, 10, 15 years later, that tree now becomes mature. Now, that is your trap, that is your investment. Capital gains has gone up, right? Now you can decide to take that huge tree, you can sell it to someone because it's now mature and it's now worth a lot more than that seed. Or you can still keep the tree and wait until that tree bear fruit, and that's your passive income, that's your dividends. So you didn't do anything for that tree at that point. It has then matured and now producing its fruit, right? So you can think of investing in companies similar to that as well. All right. Now, before we get into here, I just want to share a story real quick. There was a gentleman named Ronald Reed. You guys can Google him. He essentially was he worked in the Marines years and years ago. He died at age 92. And he actually lived a very poor life, but when he died, he had $8 million in his estate. So no one knew that he was actually wealthy till he died. And the way that he created his wealth was actually based on those rules that we just looked at. He worked as a janitor for 25 years. He worked as a mechanic for 17 years. So he probably earned a lot less than everyone in this room here. And he was able to amount $8 million when he died. Now, he died at 92, so you know that took him a long time to do it. But it still helps someone in his family at the end of the day. Now, what he essentially did was he purchased blue chip companies, and essentially blue chip companies are like the top, largest companies, the best companies right now. So like blue chip companies today would be like Google, Facebook, Apple. Those are considered the blue chip companies. Companies that earn a lot of income, everyone uses, that are likely to be around. Those are blue chip companies. He didn't know a lot about investments. He just said, okay, well, I think if I buy quality companies, good companies that will be here for the next 30 or 40 years, by default, I'll make more money. And he did that for his entire working career. Every time he got paid, 10%, he would just buy the companies. And he lived in a regular house and he had a regular car. All his friends were poor. Each one he just put that 10% aside. It was a principle that was instilled into him, and he did it. And when he died, he amounted wealth. So I just hope that shows you that none of us in here need to be smart. We just need to have the principles in place. Find good companies, take at least 10% or whatever amount makes more sense to us, and put something aside. Think of it like you're planting a tree. 30 years later, you have shade or you have fruits from that tree. Now, let's look at different types of investments, right? So we have traditional and we have alternative asset classes. So traditional investments or asset classes would be like asset classes that the average person invests in. Alternative asset classes would be usually for more sophisticated investors or people who can invest maybe $100,000 one go, right? So what are those asset classes? So let's look at retail investors. So retail investors, they normally focus on a mix of these two here. So you have stocks, ETFs, mutual funds, and real estate. Now, real estate falls under the alternative asset class as well, because you have a lot of wealthy investors that invest in real estate. And you have a lot of retail investors who can't afford to invest into real estate. So that falls in the both institutional and retail investors. But let's look at the ones that are available to the average person. So we have stocks, ETFs. So ETFs basically would be considered investment like an index. It's called an exchange traded fund. That's what it stands for. And it would track basically like the S&P 500. So all the companies that the S&P 500 monitor tracks, ETF will do the same thing. And you can basically invest into that at little to no cost. ETFs are extremely cheap. So if you're going to be a passive investor, you don't want to do all the reading, the ETF is a very easy way to invest into like the S&P 500. And then you have mutual funds. Mutual funds are also pretty good, but you have to understand what they're doing. You have to make sure those funds aren't charging high fees, because those fees affect the compounding rate of returns that you get. And a lot of mutual funds don't survive longer than 10 years. So you have to know a bit more about, the mutual funds you invest in. But mutual funds basically is like, it's a pool that has a lot of cash in it, and it pulls in more cash from investors, and they take that cash and invest it into different assets. It could be public companies. And then you have stocks. Now, These investments here, the stocks, investment fund, they're very liquid. So like if you have $100,000 in these assets and you want to get that money today, you can get it in like a day or two. Now these asset classes here are set for REITs. REITs is basically an index of a real estate portfolio that's traded in the public market. So that's very liquid as well. So if you don't want to invest in real estate, you can invest into REITs. Not saying that we guys should do. I'm not a fan of REITs, but I'm just saying like that's another way to invest into real estate, and it's very liquid. You can pull your cash out in a day or two. Versus if you want an apartment complex, you have to wait for someone to come and buy it. So it's a liquid asset, right? You can't get cash for it right away. And then you have hedge funds, which again is like a pool where a lot of cash is pulled together from different investors, and they invest into different assets. It can be distressed assets, public companies, private companies, bunch of different strategies. They can do trading, they do all sorts of stuff. And then you have private equity, which is basically another sort of a fund that invests in private companies. So where we have public companies, the stocks, we have private equity. This is a fund that does the same exact thing as that, but they focus on private equity rather than public equity. So private companies instead of public companies. And we have structured products. So structured products, this section here, just think of it as the more complex stuff. More like you guys probably wouldn't get into this stuff. But if you do, I just want to like give you a bit of exposure to what these investments are. You have structured products, and basically structured products is like a financial instrument that's created by investment banks to track several assets. It could be one or two. So they say whatever these assets do, the structured product will track the performance of those assets, and you get a return based on whatever agreement you put together. A lot of complex stuff. I doubt most of us will be using those, but if you guys are interested, just want to share that with you guys. And coming to the end of the presentation now. So let's say you guys decide to actually want to invest into like some sort of investment, whatever it is. You want to be able to understand that in the investment world, there's investments that you can get by taking zero risk, and there's investments that you can get by taking risk, obviously. So for example, you can invest into the government treasury bonds, which is basically a debt obligation by the government. You basically lend money to the government and they give you back a rate of return. So right now interest rates are high. You can lend money to the government. You can collect 5% interest on your cash by taking no risk. Essentially, the only risk that you're taking is the government might default, but it's the US government. They have a big machine that prints cash. They don't have a default. So you don't have to worry about that. So it's essentially a risk-free investment. So for example, if you know that over a 10-year period of time, you can invest into treasury bonds and you get a return for 5%. Whatever investment that you're doing, it has to be above 5%. Otherwise, it wouldn't make any sense. Because if I can invest 5% and take no risk, why would I invest into this company or your company or whatever investment and get 5% and take a lot of risk? It just doesn't make sense. So you want to have like a benchmark. So always use the US Treasury bonds as a benchmark. So if you can get free returns here, whatever investments you do have to be above that. Right? So that's essentially what this slide talks about. And then what can you guys do today? This is the last slide. So essentially, I just want to encourage all you guys that if you want to create wealth and not have to work for the rest of your life, at the end of the day, when you retire, you don't want to depend on a pension, because pensions, they return anywhere from 5 to 7%. So you won't get a lot of wealth. You need 10% or higher to really build wealth. So pensions are good, but I don't want you guys depending on pensions, right? And that's the only way the average person right now invests, by a pension. None of us really know how to invest. They don't teach it in school. Yeah, they don't teach you investments in school, right? So none of us will ever know until we get out of school, right? Maybe just can get thrown into companies and then we end up don't understand how money really works. But essentially, you want to always put money to work. Think of it as a seed that can be planted, that can grow. So what can you do today? You can start with yourself. That's the best investment you can make. So come to seminars like this and learn about stuff. Read books, do research, and just understand the requirements that it takes to be a good investor. And number two, you can focus on industries that you understand very well. Like for example, you in the gym industry, you understand how the financials of a gym work. You understand how the economics work. If you see a gym that's for sale, a company, for example, or a public company, and you see that, okay, well, this gym is actually doing very, very good. I can invest into this gym because I understand gyms. Or let's say you deal with shoes, you understand shoes because you see a lot of shoes all the time, whatever. You know a company selling shoes and you see that company could be the next Nike.
Yeah.
and you understand that because you know about shoes, you can invest into those startup companies. So you want to invest in what you know. You don't invest in like a biotech company that produces chemicals and
Yeah.
scientific crap that none of us understand, right? You want to avoid investing in those things because you don't understand it. So you invest in what you know. And you can think of simple investments. Like we all know Coca-Cola. We know the economics behind that. A Coca-Cola costs $1.50 or $1.